All right, in today's video, we're covering market volatility and then going through 3 different scenarios, each in a different market environment, that show market volatility can actually be a good thing. When markets are volatile, as they have been in 2022, investors sometimes get really uncomfortable. When your portfolio temporarily loses value, it can be very tempting to try and minimize your losses by stopping your regular investment account deposits. We all go through this. But unfortunately, when it comes to investing in a volatile market, what feels right is often wrong. In this video, we'll show you why it's important and even beneficial to keep investing despite market volatility. This all stemmed from an investing seminar our co-founder Andy Ratcliffe gave years ago, in which he showed members of the audience 3 graphs depicting different market behavior. He asked them which type of market they'd prefer to invest in periodically if they didn't intend to withdraw their money until 10 years from now. Here are the graphs, illustrating an example of how an index-based ETF could fare in 3 potential market scenarios. So, you probably wouldn't be surprised to learn that chart A was the most popular choice, while chart C got the fewest votes. However, you might be surprised to discover that chart C actually represents the best market environment to invest in, while chart A is the worst of the 3. Let me know in the comments if you were surprised to hear this as well. Hit that subscribe button as well. Let's dig into each scenario. First one, investing in a steadily rising market. So this table shows an example of the potential price and number of shares of an index-based ETF that an investor might buy in a steadily rising stock market if they were to invest $1,000 on January 2nd each year for the next 10 years. As you can see, our investor will own 46.55 shares of this ETF, which will be worth $23,275 when they're ready to liquidate their portfolio after 10 years. Again, this is assuming that they invest $1,000 on January 2nd for the next 10 years. Now imagine our investor faces a rising but volatile market over the next 10 years. This table displays the potential purchase price per share and the number of shares purchased for the same ETF in those market conditions. On the 10th anniversary of their original investment, the investor will own 48.42 shares of the ETF, which will be worth $24,210 when they're ready to liquidate their portfolio. Now, this one's interesting and it surprised me as well. Investing at a constant clip in a rising but volatile market leads to a greater value than investing in a constant clip in a steadily rising market. That's because the investor gets to buy these investments at a relative discount due to volatility. Number 3, investing in a declining market. This one really surprised me. So this table shows an example of the potential price and number of shares of an index-based ETF an investor might buy in a steadily declining stock market if, again, they were to invest $1,000 on January 2nd each year for the next 10 years. Most shockingly, this third scenario leads to the greatest value upon liquidation by far. It's not even close. That's because, in effect, you're buying the ETF at a steep discount. It doesn't matter that the ETF declined during your investment period. All that matters is what it's worth when you're ready to liquidate your account. Just take a look at the final results on this screen and you'll clearly see just how much more the declining market helped that investor. Again, it's truly not even close. All right, so what's the point of this? The point of our example is that the interim volatility truly does not matter. A volatile market can actually work to an investor's advantage because it gives them opportunities to buy at a relative discount. That doesn't mean you should wait for a volatile market to invest, because it's nearly impossible to time the market. The lesson here is that you should ignore the behavior of the market if you intend to invest steadily and don't plan on touching the vast majority of your account for a number of years. We've all seen markets generally rise over time. So if your investment horizon is fairly long, let's say at least 3 to 5 years, then what happens in between that doesn't matter very much, as long as your portfolio is ultimately worth more than what you paid for it. Now, loss is uncomfortable, right? It gives you anxiety. Even if it's temporary, even if you know in the back of your head this is temporary. But it's important to remember that volatility is a truly normal part of investing. And you don't actually lose any money unless you sell your investments for less than what you paid for them. History shows us that markets tend to rise in the long run, which means if you stick to your strategy and keep investing, you're likely to come out ahead. I'm sorry to say this, but there's no secret to success here. All you need to do is make a plan to invest regularly and then stick to it no matter what the market does from day to day. And this can sound boring, so I get that, especially when all you hear about are people making millions of dollars off NFTs. But this is the ultimate sound strategy for long-term success. And if you want to buy that NFT, have at it. Just make sure the majority of your investments are in these index-based ETFs. All right, this is Tony from Wealthfront. Hit that subscribe button, and we'll see you next week.